Dividend investing is a very trendy investing strategy that many investors follow, especially in the FI community. But how much actually do you need to be invested to live off dividends? Today, let's tackle this question and talk about the problems of dividend investing. How can we achieve your target number, whatever that might be? This will be the first video of my income investing series. I'll be going through the investment vehicles that offer high dividends. For your alert, not only the high dividend stocks. My name is Irene. Now let's get started. If you're familiar with FI movement, you must have heard of the 4% rule. This is called the 4% safe withdrawal rate. So to put it simply, the size of your portfolio should generate 4% after inflation every year to cover the expenses of your retirement lifestyle. So for example, in Australia, if we base on average yearly household spending for 15-16 financial year, this is the most updated data we can access from ABS, which is $1,425 per week. Then we times 52 weeks, and that gives us the number of $74,000 per year. So if this is the annual expenses, $74,000 per year, you divide it by the 4% withdrawal rate, and that gives us 1.85 million as the size of your portfolio. Dividend investing, however, takes another approach. They only want the dividend income to cover the expenses of your retirement lifestyle. Wait a second, what's the difference between these two? One is to withdraw, the other one seems like not touching the principal. While dividend investing sounds better to me. The 4% rule is not necessarily touching your principal. You seem to be confused. Maybe let's briefly talk about the two types of returns. So there are two types of returns. One is the price return, the other is income return. Let's talk about the price return. For example, I bought one share of Tesla at $180 and now it's worth $950. The price return is $900.50 minus $180 divided by my cost, $180. So Tesla gives me 427% price appreciation. It's also called capital gain, capital return, or capital growth. The second type of return is the income return. So this is the return from any cash in hand by holding an investment. So this could be an interest from a high interest account or term deposit or bond coupon interest, dividend, distribution, or rent if you have investment property. So for example, I bought one share of VHY Vanguard Australian Shares High Yield ETF at $59.50 1 year ago, and I have received $4.48 dividends since then. So the income return generated by VHY is $4.48 divided by my cost, $59.50. That gives me 7.5% income return. It's also called income gain or yield return, but pay attention here, the dividend yield or the rent yield are not quite the same as the income return, because the dividend yield, you have to divide the current market price of a stock, while the income return that you have to divide the price or the cost of the investment you paid. And the price return plus the income return gives you the total return. Back to the 4% rule. This 4% plus the inflation rate is definitely referring to total return. That includes capital gain and income gain. So as long as your portfolio can generate 4% plus the inflation rate, whatever you withdraw is the profit. You're not touching the principal. And on the other hand, dividend investing is kind of like buying the hens for the eggs and hoping to leave out the eggs and keep the hens growing. But you have to make sure the hens are in good health and they can't sacrifice themselves just to get the eggs, because if the hen is bleeding inside, she's not going to produce good quality eggs and perhaps she's not going to survive for long. Are we still talking about dividend investing? Anyway, I'll go into detail in my income investing series video. So if we follow buying the hens for the eggs dividend investing philosophy, how much needs to be invested comes down to two factors. One is your annual expenses and second is your target income return. So let's talk about the annual expenses. Everyone's desired retirement lifestyle is different, so therefore your spending figure will be different. You can use your current annual expenses as your benchmark and work it from there. I've got a free template annual expense tracker for you to download here, so feel free to grab it. So you can ask yourself any fixed expenses, something like, will you still need to pay any rent or mortgages, or is there any future education costs that you need to budget in? For example, your kids' private school, or you want to support your grandchildren's education and so forth. And any debt expenses, will there be any loan repayment? or any unexpected and discretionary expenses. For example, do you want to budget more dining out and holidays? And I often hear people who have rich FIREs say that they should have budgeted more on the medical costs. So for demonstration purposes, that we will use the ABS average household annual expense of $74,000 here. And now that we just need to work out our target income return. So the average total return of ASX 200 index fund for the past 10 years is 9.3%. And income return takes almost half of it. So if we take this data as reference and say, if we expect our yield return, the income return, to generate 4%, so we have 74,000 divided by 4%, that gives us 1.85 million. Wait a second, the number ends up exactly the same as if we follow the 4% rule, only that we don't need to sell any stocks. Too good to be true. Actually, we got a problem here because the assumption of 4% income return, that's before inflation. So let's break it down here and assume our expected target income return remains the same and we stop buying any investment. So year one, your size of your portfolio times the income return should cover the annual expenses, right? On year two, your portfolio size actually will be increased by the weighted price return, ideally, but in reality, it may go down. Times the target income return should cover your annual expenses, but these annual expenses will be inflated by the inflation rate. And on year three, and so forth on year end. So we can see here, every year the annual expenses will be increased by the inflation rate, but don't worry, your portfolio size will also increase by the weighted price return of all your investment, ideally. Again, this might go down in some years. So as long as this price return keeps up with and exceeds the inflation rate, we'll be fine. What we don't want is to expect a much higher income return, which we all want, and then sacrifice the price return, which means that essentially our portfolio size will shrink. This is because the price return and income return are always trading off. You can hardly find any high dividend stocks that can provide a high income return, can provide a high capital growth at the same time. This is why many tech companies, especially in their expanding stage, that they don't pay any dividends. Rather, they want to reinvest back into the company. So let's talk about the problems of living off dividends and handpick those high dividend stocks and ETFs. So problem number one, the high dividend stocks price return may not keep up with the inflation rate, which means that along the years, the size of your portfolio will shrink. So the income that generated by the dividends cannot essentially cover your annual expenses, even that the income return still remains high. The second problem is that the hidden opportunity cost of pursuing only high dividend stocks and ETFs is pretty high because you may miss out other investment opportunities that can generate a much higher total return. So I'll show you an example. If we look at VAS and VHY, VAS is Vanguard Australian Shares Index ETF and VHY is Vanguard Australian High Yield Dividend Index Fund. So hypothetically, 1 million invested into each ETF 5 years ago, and VHY's income return is 6.59%, and VAS income return is lower. If you are a dividend investor, of course, you will go to the VHY because that provides a higher income return. But if you look at the total return, VAS generates 4% more than VHY in total. So if VAS 1 million, it will turn into 1.3 million in 5 years' time. But VHY is 1 million turned into 1.1 million. So which one would you choose? I'll choose 1.3 million, of course. So when we decide what dividend investments to buy, I think we need to take a step back and maybe look at the total return as well, even if that means that you have to sell some of your shares to realize that capital gain. It's not your principal, it's the profit. The last problem is that the dividend payout to shareholders may vary throughout the years. So a company that pays out $6 per share may increase or decrease in the future. So there's a little bit uncertainty here. So what you can do is either to build a bigger size of your portfolio to give some buffer, or you may need to realize by selling off some of your shares or ETF to realize that capital gain. So once you have worked out your annual expenses and set a realistic target income return, then you will come up with the size of your portfolio. Say, for example, 1.5 million. So how can you build up 1.5 million and how many years that does it take? So you can go to one of those websites by using compound interest calculator. I'll recommend Money Smart, and set your initial investment balance, your 8% annual return. This is the total return, and target year, say 10 years. In this case, that you would need to invest 8,000 monthly to reach out that goal. Well, everybody's numbers are different. Some may have a larger initial balance saved up, and some may have more after-tax income coming through. So you just need to work out your number and work out a practical plan for you. All right, guys, I hope you like this type of content, and hit the like button and let me know. My name's Irene. I'll see you next week. Bye.